You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Haleon, Rightmove, Primary Health Properties, Wilmington, Taylor Wimpey, and our US company of the week is Nvidia. Sam, shall I kick us off with Haleon?
Absolutely. A company that's grown on us.
It absolutely has, and it's been growing in the share price too. So Haleon, for anybody who doesn't know, was the consumer health division that was spun out from Glaxo a couple of years ago. And it has brands like Sensodyne toothpaste, Otrivin nasal spray, Panadol painkillers, and Centrum multivitamins. They had their full year results out with full year revenue of £11.2 billion, down 0.6%, and organic growth of 5% reflected in increases in all regions and categories. Most of the growth was delivered by price hikes, with smaller but still positive contribution from volume and product mix. Underlying operating profit rose 9.8% to £2.5 billion, helped by strong pricing and cost discipline. Free cash flow of £1.9 billion grew by around 400 million, and net debt fell from 8.5 to 7.9 billion. For 2025, organic revenue is expected to be increased by between 4 and 6%, with high growth in underlying operating profits. Haleon declared a final dividend of 4.6 pence and an increase of 10%, as well as a £500 million share buyback for 2025. And the shares were down around 2.5% in early trading. In terms of valuation, Haleon has a market cap of £36 billion and trades at 20 times forward earnings with a prospective dividend yield of 1.8%. I thought these results were all right, actually. I think we've got used to the last couple of quarters from Haleon being really quite positive. And that was something that we weren't sure when it started. It was a little bit stop-start, and it had been loaded with quite a lot of debt after being spun out from Glaxo. I think the other thing that had sort of put maybe high expectations on Haleon was before it was spun out, there were rumours that Unilever were going to pay $50 billion for it. So putting a really high premium on it. But overall, I think it's chugging along in the right direction. It's got decent brands. I don't think they're the very best in the business, but they're decent. And it does seem to be paying down that debt, which is great. I suppose one question is, where the significant growth comes from, perhaps with some of those brands. They are launching new ones, though. There's Orox, which is an erectile dysfunction cream, and I think they've got a few more sort of in their sort of pipeline that they're going to be coming out with soon, and then spinning off some of the less desirable, less power brands. Dividend, it's only 1.8%, but I suppose with the debt and some of the priorities in terms of how that might be managed, you wouldn't expect it to be competing with some of the peers yet. I think at a forward earnings of 20, it's quite expensive, and because it doesn't have those very top brands, I would probably be buying an alternative like a Unilever. I know I'm very biased towards Unilever, but a Unilever which is cheaper at the moment. And I think with that new chief executive, Fernando Fernandez, probably got a bit more momentum with it and a bit more poised for growth in the near term. And the valuation and dividend with Unilever are more appealing. So it wouldn't be one for me right now, but I think it's certainly not a bad company. Sam, what are your thoughts?
I think they're a decent set of results. Again, considering the position they were put in when they were spun out, I think they've done very well since then. I think the organic growth of 5% is pretty good. It's above inflation, which I think is all you can really ask for. I think the overall revenue growth decreasing, I'm guessing that's just because of the sale of Sensodyne and a few other things that have been spun out in the last year or so.
Yeah.
I think the debt, and I take what you say about the dividend being low, but I think that debt's still high, and I think they've done a really good job managing the debt. But the debt is still, when you've got underlying operating profit of 2.5 billion and net debt of just under 8, that's come down by a good chunk. It's come down by 600 million. But although it's not a level where you'd be concerned about it, it's still that it's probably at a level above what you'd ideally want to see. So I think in terms of management, I think it's pretty sensible focusing on paying down the debt rather than the dividend. And I suspect that's why the price to earnings is a bit higher, because I think once that debt is paid off and a lot of that interest comes out, I suspect if you were to then take a normalised PE, I think it would then be probably more in line with peers. I do agree, though, you kind of get to the same point where it's what brands could you have instead? And like say, you could have Unilever's brands, or you could even, I know they're not doing as well at the moment, but you could have Nestle for a similar price, which I'd definitely rather own. So yeah, I think they're a good set of results. I think they're doing well. But yeah, it's considering that Nestle is probably sat on your watch list right now at a price at which you'd find quite attractive, you're just not going to look twice at Haleon. But I think in a few years it could be there.
Yeah, no, absolutely. Fair enough. Shall we move on?
Yes, to a company that we both own, Rightmove.
Absolutely, yeah.
So Rightmove have come out with their full year results, and revenue was up 7% to 389.9 million, but operating profit was down 1% to 256.3 million. And underlying operating profit was up 4% to 273.9 million. The final dividend was up 7%, and the total dividends for the year were up 5%. Basic earnings per share was flat, but the underlying basic earnings per share was up 4%. I did have a look at it before, but I'll just see what the changes were between the adjusted and the actual, because I think I did highlight it somewhere. Oh, here we go. So the underlying operating profit was up 4%, with underlying operating profit margin of 70%, in line with guidance. And they said that the operating profit in terms of the UK GAAP figures were down 1% due to the impact of one-off transaction-related charges of 9.2 million. So that's why, which seems kind of fine, but I'd prefer it when they just keep that in there. I think, there's always going to be one-off stuff most years. I think the threshold for it being adjusted should be a lot higher, but that's not a criticism of Rightmove. That is a criticism of pretty much every company that reports earnings. The revenue was up, as mentioned, 7% as estate agency and new home developer partners continue to upgrade their packages, increasing their use of digital products and renewed contracts. I think the new home developers, that's generally a sign that the market's not quite as hot, because if, when we were looking at it in COVID, a lot of them were coming off Rightmove because they just couldn't sell them quick enough and they didn't need to pay the fees. So I think that's, obviously it's good for Rightmove, but I think it's a bit more indicative of what's going on in the property market potentially. 181.7 million of surplus cash was returned to shareholders through buybacks and dividends, and that compares to 201 million the year before. And cash and cash equivalents at the year end was 41.3 million compared to 38.8 million the year before. So they've had sustained traffic growth with a total of 16.4 billion minutes spent on the platform in the year, and that's up 6%. And they now account for over 80% of all consumer time spent on UK property portals. And Rightmove was the fourth busiest UK-based digital platform in 2024, behind only the BBC, digital publisher Reach, and the government's own website, gov.uk. So that's not bad. And they've also had their quickest ever uptake for a top package, which is their Optimizer Edge package. And they've got the second highest estate agency retention in 10 years, which again, I think indicates partly the state of the property market at present. The headcount was up 14% to just under 900 employees, with 60% of these recruits in technology roles. I think it will be interesting to see what these are used for, because it's not the kind of business you expect to increase headcount 14%. And the average revenue per advertiser rose £93 to £1,524 a month. The estate agency average revenue per advertiser was £1,440, increasing by 6%. And new homes developers' average revenue per advertiser was up 9% to £1,987. Total memberships increased by 1% to 19,047. And estate agency branches were up 2%. New home developments were down 1% since the start of 2024. Average total membership across the year was flat, with estate agency up 1%, offset by new home developments down 4%. And they've said that for next year, they expect revenue growth of 8 to 10%, which in fairness, so do we, like clockwork, which is one of the reasons we like the business. So In terms of the valuation, the business trades at a PE of 26 and has a yield of 1.42%. My thoughts as a shareholder, I don't actually think it's an amazing set of results. I think the revenue's done what I expected. The operating profit is basically flat, which is a bit disappointing, but it's still pretty good. I think for a PE of 26, for a company that is still growing 8 to 10% a year, like clockwork, and has a monopoly, it's not cheap, but I think it's pretty decent. So overall, I'm pretty happy with it, but I wouldn't say this has been the best year I've ever seen from Rightmove, but equally, it's not a terrible year. What about you, John?
Yeah, no, I would largely echo that and think we haven't seen major disruption from on the market, which as a Rightmove shareholder is a big relief. And yeah, I think these results are probably what you describe as consistent rather than groundbreaking. But that's fine. I'm happy with that. And if they can continue on a similar track, again, be very happy with that.
Right, should we move on to a business we've not covered for a while?
Yes, so it's Primary Health Properties, which is basically a real estate investment trust that specialises in GP surgeries, so sort of primary care in the UK and in Ireland. Yeah, it's one we haven't covered for a while. I think it's sort of, we lost a bit of interest in it. It's not something that ever sets growth alive, but it had decent dividend of what was probably sort of 4 or 5% sort of historically. But the market has changed a little bit, and I think we've had a new commitment over the last sort of 6 months since the election to more spending in primary care. And with Wes Streeting, there's not that sort of Corbyn-style risk that would involve nationalising and whether you call it asset seizure of these sorts of privately held buildings within the NHS. Let's go to the full year results, though. The group had a reported 2.9% rise in net rental income to £153.6 billion and a 2.4% rise in underlying profit to £92.9 million. Growth was largely from rent reviews and asset management projects, offset by higher costs. Occupancy dipped from 99.3% to 99.1%, and the portfolio value was broadly flat at £2.8 billion, with values stabilising in the second half. Loan to value on the portfolio worsened from 47 to 48.1%, and dividends over the year totalled 6.9 pence per share, which was up 3%. And the first interim dividend of the new year was paid on the 21st of February, totalling 1.77 pence per share, and the shares on these results were broadly flat in early trading. In terms of valuation, Primary Health Properties has a market cap of £1.2 billion and trades at a forward price to book of 0.87 compared with a 10-year average of 1.15, and it has a prospective dividend yield of 7.7%. I thought these results were okay. As I sort of said in the outset, you don't expect them to be setting things on light with growth. But given that, and given the very cheap valuation with the dividend, and also with that guaranteed occupancy, which is essentially underwritten by the government, I think a dividend yield of 7.7% is very attractive. We're not in the zero interest rate environment, which this group historically grew on. And I appreciate that from a growth point of view, that's probably going to be a more limiting factor. Their main competitor is Assura, and it looks like that might be sold out to private equity. I think that Primary Health Properties actually looks like it's in a good position to take advantage of that. And I think from a volatility point of view, there probably isn't going to be very much because, as I say, from a political stance, I think both parties are committed to more spending in primary care. GPs on the whole are much less interested in owning the buildings compared with historically. And I think the funding is really going to be from these two big businesses. And again, when it's underwritten by the government and you've got such high occupancy, it's, I think, very, very attractive. And I suppose with the rules of real estate investment trusts and paying out a fixed percentage, I think this is pretty good, actually. I think the concern that I would have is just with interest rates being that higher and then the loan to value worsening slightly, that would be the thing that would make me a little bit more hesitant. But I think this is one that's probably worth digging into a bit more and following over the next year. But it's definitely one that's going on my watch list. Sam, what are your thoughts on primary health properties and this set of results?
Yeah, I think it looks a lot more attractive than the last time we saw it. I think you'd probably buy it assuming there's no capital growth. There might be. I don't know what's going to happen with those properties, but you'd assume no capital growth. But you're getting it under book value, which historically is traded 50%, 15% over. And, a lot of the time on the show, we'll make the argument with these income stocks, well, you can get 4% in the bank account, so why would you go and buy it? But you get nearly 8% here. So I think it's actually it's an attractive yield. And they have 29 consecutive years of dividend increases. So far, it's proven to be well covered. I think what I'd want to understand is, in terms of that loan to value, what is the maturity profile of a lot of that debt and what kind of rates they're on. So, for example, other loan to value we know might be quite high, is a lot of that still locked in on quite cheap rates from 3 or 4 years ago. When that gets renewed, potentially, that yield's just going to come crashing down. That might not be the case, because what tends to happen is they're all coming up for renewal at different dates. So you'll have some you win on and some you lose on. The other thing, and you might know, is what happens in terms of rental increases. Do they sign up with like a GP practice and then they're kind of locked in and then it's renewed, and it just tends to be someone comes around and just says this is the market rate of rent? Or how will they build in inflationary increases in the contract? Or
yeah, so they generally have district valuers who come and do rental reviews. I'm not sure how regularly that is and whether there is a fixed term in terms of when it happens, and I suppose also how it's fixed in terms of the lease agreements that they have. The lease agreements that they do have are generally in excess of 10 years, so they're very long. But what the terms are, that's again something that I think if we dig into it further, would need to understand to sort of essentially, if you're buying the shares, guarantee that those, it's a reliable sort of rent increase from a contract on a contractual basis. But yeah, that's something that I need to clarify.
Because my other concern with it is, it's all well and good having a value come around and say it should be this, but over the long term, it kind of needs to, for it to increase over the long term, I think basically GP practices need to be doing better as well, because you just get to a point where it's eating into their margins more and more, and they will just turn around and not want to pay it.
I sort of get what you mean. I mean, I think in terms of how some of that works is that the notional rent that the GPs are paid for their building essentially ultimately comes from the government, and that it, on the sort of the district valuer coming round, whatever that sort of, say, increase is, then the rent is reimbursed the same amount, basically.
Right. So they don't actually
pay
anything.
I think that the difficulty is that they have to commit to the building and a lease agreement. But generally, if they're getting a new shiny building that's been funded by primary health properties, they sign them up to a long lease. If it's a big new shiny building, they might be signed up to like a 25-year lease on it. It's that sort of arrangement.
But is that then being paid each year out of the profits from the practice?
No. So if they're leasing it, then the rental from that is essentially coming from the NHS. So it shouldn't impact them, basically, assuming that they're getting, the reimbursements, which they generally are. That
is interesting.
Yeah. So I think that's one of the reasons that it feels so secure, because you've got these sorts of arrangements, which in a private market wouldn't happen.
Yeah. So to conclude, it is also going on my watch list, actually, and I would be keen to come back and cover this again and dig into a bit more detail at some point, because I think with that yield, it's now looking quite attractive.
Yeah, it's definitely not the same, but I know you recently bought the supermarket's property
Yeah.
REIT. Again, they're completely different sectors, but you've got really quite high yields in both of those. And I'm not sure how much risk you're taking here with primary health properties. I think some of it you would have to clarify those details in terms of contractual arrangements, and then also on the debt and how that's structured. But I think potentially on both they could be quite attractive. And it's not as though we're back 10 years ago where you were getting maybe a 4 or 5% yield and it was essentially a bond proxy with nothing. You get minimal amounts on savings. I think this is now significantly above that. So I think, in terms of level of attractiveness, it's considerably more attractive. And I think you've also seen that the share price has come down quite a lot on primary health properties, again, making it more attractive, more seriously worthy of having a deeper dive into it.
Well, yeah, because when you look at the share price, you can basically it's like the inverse of what interest rates have done.
Yeah. So, and I think also, just going back again, when you had sort of Corbyn in opposition, he really didn't like these arrangements and they were ready to kind of be scrapped under that. Whereas you've had such a big swing with Keir Starmer and Wes Streeting, which are seemingly very happy with these types of arrangements, where you're essentially having private sector funding into NHS infrastructure, which is exactly what primary health properties is. And if they're comfortable with that, if everybody's comfortable with that, you get that sort of security there. And again, nearly sort of 100% occupancy, which is pretty incredible.
Yeah, I suppose if the worst case were to happen, say a Corbyn or someone came in and did just want to kind of nationalise it, I suppose they're probably still going to get a decent rate. It's not like in Russia where they'd probably be like, "Oh, we'll give you £1." I think it's still, it would be annoying, but I don't think it would be a disaster for the shareholders because they'd probably come out and they probably would just get the market rate. That would be what would happen.
You would, if you were owning primary healthcare properties, that's certainly what you would hope for. But I guess that's, one of the relatively small risks.
Right. Should we move on to a debut for the show?
Yes. Kick us off with Wilmington, Sam.
Wilmington. So I don't. Is it a company you've heard of?
Not really, no.
No, so it's
In
not
fact,
a
I
company
should just say no, I haven't heard of it.
That's fine. So it's not a company I'd heard of until this week. But basically, for my job, we have to do a certain number of hours of professional development every year and making sure we're up to date with stuff. So what will happen is our employers will pay for sort of training providers, and you get access to like an online portal, or you can go and like do physical courses. And one of the biggest providers in my sector is a company called Mercia. And at my old place, they used Mercia. And at my new place, they use Mercia, which is probably quite a good sign. So I was looking for some courses to do the other day at work, and I noticed at the bottom of the webpage for Mercia, it said that they are part of Wilmington PLC. So I thought, let's have a look at them on the show. So Wilmington I'll just read from their About Us page of the website. So they act as trusted partners to customers who are operating in regulated sectors and in the governance, risk and compliance markets. They provide critical data and information to enable customers to make the decisions needed to maintain compliance with the rules and regulations that apply to them. And they provide training and education to equip their customers with the knowledge and skills to carry out their activities in line with best practice. So they're basically a training provider, and also they will make sure that their subscribers stay on top of like regulations and whatever regulatory requirements are required and any changes. In terms of the businesses, they've got quite a few different industries. So they've got quite a lot of health, safety, environmental training. And it looks like they also do like a similar thing that I described for accounting and tax, but they also seem to do it for law as well. I don't know how big that is. And then obviously the only business that they've got, because they've got like 9-10 different businesses. And so it looks like the legal one's called Pendragon, which I've never come across, but I'm not a lawyer. So so Mercia is the segment of the business that I have dealt with. So they have come out with their half-year results, and revenue was up 16% to 44.9 million. Adjusted profit before tax was up 39% to 11.4 million. And the adjusted profit before tax margin was up from 21 to 25%. Adjusted basic earnings per share was up 40% to 9.59p. Interim dividend was flat at 3p. Net cash was up from 28 to 31.3 million. And in terms of the statutory continuing results, revenue was actually only up 6%, profit before tax was down 36%, basic earnings per share was down 56%, and adjusted basic earnings per share was up 28%. So quite a significant difference between the actual and the adjusted figures. They've said that of that revenue growth of 16%, organic revenue growth was only up 3%. So basically they've gone and bought the growth. The recurring revenue from organic businesses was up 6%, and that was underpinned by strong retention rates. And the repeat revenues, including organic recurring revenues of 38%, now account for 72% of continuing revenues. They said they continued to enhance the portfolio with the acquisition of Phoenix Health and Safety Group in October 2024, expanding the position in the growing health, safety and environmental training market, which has also improved the group growth rates. They've said the operating cash conversion was 72%. And in terms of the divisional performance, health, safety and environmental was up 1,000%, but that's because they've gone and bought a business. I don't think they had loads of stuff in that sector previously. Legal, they're down 5% to 7 million. Insurance is down 6% to 10.7 million. Other is up 9% to 21.1 million. And financial services was up 3% to 31.8 million. I think Mercia would sit within financial services. So for health, safety and environmental, they've said the segment comprises Astutis, which was only acquired in November 2023, and then Phoenix Health and Safety acquired in October 2024. And they've said business performance is strong, with both businesses delivering year-on-year double-digit revenue increases. In legal, they said the legal segment comprises Bond Salon and Pendragon, whose customers are predominantly in the legal market. Legal revenues declined 5% organically due to notably large contract wins in Bond Salon in the first half last year that have not yet repeated. Pendragon had a strong year for subscription revenue growth and again achieved very strong customer retention at 99%. Financial services insurance comprises Axco and FRA. Financial services insurance revenues declined 3% overall organically. Axco grew revenues 6% organically and had a strong year for subscription revenue growth. Recurring revenue retention rates were at 99%. And then they've said in financial services other, that comprises 3 businesses that operates in compliance markets, ICA, CLTI and Mercia. Overall revenues from these 3 units grew 9%, with Mercia up 11% and ICA and CLTI combined revenues up 7%. In terms of the valuation, the business trades at a PE of 18 and has a dividend yield of 3.22%, and it has a market cap of 315 million. I was interested just because the Mercia platform is a very good platform. Also, I can imagine it's very sticky. I think the fact that I've had 2 employers and both have used it was quite an encouraging sign. Having actually looked at it, it seems like a lot of the figures are quite stodgy. Like some of those growth rates are maybe not as high as I would have hoped for at 18 times earnings. The yield's not hugely high. I don't love the strategy of going out and acquiring growth. However, I think health, safety and environmental, it looks like 2 years ago, they basically had no exposure to it and they've now got a decent sized business there. So I guess because it's sort of helping them get into a segment they weren't previously in, I can kind of understand it. But I think I probably hope to see a little bit more from it, given the quality of the Mercia platform. So for me, I probably wouldn't want to look at it again, but interesting to have a look. What about you, John?
Yeah, I suppose the growth through acquisitions and just doesn't particularly excite me. So I'd probably just leave that. I wouldn't go any further with it.
Fair enough. Should we move on to a business or certainly an industry that does excite you?
Well, yeah. So Taylor Wimpey, one of Britain's biggest house builders. So I think it's maybe it's second or third. They had their full year results out last week. And the group had revenue falling by 3.2% to £3.4 billion, as an uptick in sales rates was more than offset by lower average selling prices. Operating profit fell by 11.5% to 416 million, which was in line with market expectations. And the decline reflects the lower selling prices and increased building costs. The group completed a total of 9,972 new homes in the UK in 2024, excluding joint ventures, down slightly from the 10,356 in the prior year. As of the 23rd of April 25, the order book stood at £2.3 billion, which was up from £1.9 billion. Free cash flow improved from 123 million to 162 million, and the net cash position fell from around 700 million to around 600 million at the year end. In 2025, full year completions are expected to be in the 10,400 to 10,800 range, weighted slightly towards the second half. Build cost inflation is expected to be in the low single digits. Final dividend of 4.66 pence per share has been announced, taking the full year total to 9.46, down from 9.58 in 2023, and the shares were broadly flat in early trading. In terms of valuation, Taylor Wimpey has a market cap of around £4 billion and trades at 0.93 forward price to book, compared with a 10-year average of 1.48 with a prospective 8.4% dividend yield. I guess these results are what we've come to expect now that we've covered a few of the house builders' full year results in recent weeks. Certainly a bit disappointing, but they do have a strong forward order book. And I think that the long-term trend is a positive one. From the building sector point of view, you would hope that interest rates are going to be continuing to taper downwards and that there's going to be that demand in the market going to filter through, and in combination with those lower interest rates stimulate demand further. Build cost inflation is certainly an issue, and I think the group are addressing that, and operationally they seem to be pretty good on that front, although it's an issue across the sector. In terms of comparing it with some of its peers, you've got, I suppose, Taylor Wimpey, which is across the UK, but it's perhaps more southern compared with, say, Persimmon. And then I think also in terms of where it's operating in the market, it's at the lower end compared with the Barratt Redrow, which has now got Redrow in it, which again has those sort of slightly higher margin, larger properties in it. I'd probably stick with Redrow, but I think Taylor Wimpey is overall well run and well positioned for what I'd hope to see the growth in the housing market over the next 5 years. Sam, what are your thoughts on these results and Taylor Wimpey in general?
It's not a great year, I don't think, but the guidance for the next year, back to business. So I think kind of just got to let them off, really, because they seem to have bounced back now. I think the dividend yield's very attractive, but that is the case with all of them. Interestingly, an article I've seen, it suggested that they'd prefer seeing them switch to a mixture of dividends and buybacks, just because the shares are trading below book value for the first time in a while, so arguably could return more to investors. But I don't necessarily agree with that argument, because the investors can always buy more shares if they want with their dividends, I guess. So yeah, I think it's pretty good. I think actually if it were me, I'd probably Taylor Wimpey as the house builder I would want. I think just in the time that we've covered it, operationally, it's probably performed the best. And I think in terms of the management, I think they've probably made some of the smartest decisions. But there's not, once you get to kind of the top 3 or 4, there's not a huge amount of difference between them anyway. And I think the share price performance is usually pretty correlated. But yeah, I think not the best year, but I think very attractively valued. And it looks like next year should be a lot better.
Fair enough. Would you consider shares in the house builders?
I don't think I would, but I have to say it's getting a bit more tempting, I think. But it's the same with, primary health properties. It's a business I would have never considered a couple of years ago. And then all of a sudden, once you start getting to these 8-9% dividend yields, it does pique my interest a little bit, especially something like a house builder, because you're getting an 8.4% yield, but there's also potential for the share price to increase quite a bit as well. So the business is still growing as well. Primary health properties, I don't think you're going to get that same level of growth, but there's quite a few businesses now where you're almost getting tobacco valuation yields, but the businesses are still growing. So I think there's quite a few like that where actually you could, it's getting to the point where I think you could probably go and construct quite a decent portfolio in the UK that was yielding like 6% plus a year, which a few years ago, which would have been fantastic. But yeah. I think it's definitely getting more interesting as the yield gets higher.
Yeah, fair enough. Okay, then on to, the biggest growth story of probably the last 5 years.
Yes, Nvidia. So needs no introduction. We've covered it multiple times before. They have come out with their fourth quarter results, and sales grew by 78% to 39.3 billion, ahead of forecasts of 38 billion. Data center sales were the primary growth driver, and sales in the much smaller automotive division more than doubled. Operating income grew broadly in line with sales to 24 billion. Free cash flow was up 38% to 15.5 billion, despite fourfold increase in capital expenditure. Nvidia finished the financial year with net cash of 33.2 billion after lease liabilities. Shareholder returns increased from 2.8 to 8.1 billion, mainly made up of share buybacks. First quarter revenue is expected to be around 43 billion, 2 billion ahead of market forecasts. Underlying gross margin guidance is 70.6% compared to market forecasts of 71.5%. In terms of the valuation, the business trades at a forward PE of 29.2, and that compares to a 10-year average of 36.5, and has a prospective dividend yield of 0.03% compared to a 10-year average of 0.39. I think these are fantastic results. There is nothing to criticise in these results, as there hasn't been for probably several years. Absolutely fantastic for a company. I'll just check the valuation, but for a company of this size to be putting in these kind of numbers is unbelievable. So this is a business that's got a market cap of 2.86 trillion, and it's still growing 78% a year. It's just absolutely unbelievable. I know we say it every time. At some point we have to be right, but I'd feel so uncomfortable paying 30 times earnings for a business worth 3 trillion. And I think it has continued to put up these ludicrous numbers. But I think this is a fairly cyclical business. You can't buy a business this size assuming it will continue growing at 78%. Now, at a 29 times forward PE, it doesn't have to do it for that long before it becomes quite a reasonable valuation. But yeah, it just concerns me with the cyclicality, because I don't know how much it has the potential to drop off. And that could seriously impact the valuation. But fantastic business. Interesting to follow, but I just wouldn't feel comfortable because I'd really struggle to value it. What about you, John?
Yeah, I mean, mind-blowing numbers, and as you say, on a company this big, how they can be doing that. But I think it does make us nervous, both of us. We did toy with the idea of putting it in the fantasy portfolio. I think it was
did
in 2020.
I shot it down.
You shot it down because you're like, I can't grow at this rate when it's got a market cap of nearly $1 trillion. But I suppose I think it was probably even smaller then. Actually, it might have been more like 200.
So it would have been enough for us to beat the world index. I think that would have been the difference if that had gone in. But we would have sold it after the first year.
That's right.
I think it doubled.
And whilst we mooted it with our own money, I don't think we'd have done it. And therefore, if we're trying to be realistic with a fancy portfolio, it wouldn't have been one that we went for. So yeah, I think it's an incredible company, but it's just, I think with the numbers, you just wonder at what point does that change? If there's anything was sort of fundamental in terms of AI. I know there's DeepSeek, and there's a few jitters over that. But if there was something that came along like that, and you paid, such a top evaluation, so not for me. But wow, what a business!
So, of the 6 businesses that we have covered then this week, Haleon, Rightmove, PHP, Wilmington, Taylor Wimpey, and Nvidia, which do you like the most, and which do you like the least?
Oh, tough one. I would probably say that I like Rightmove the most. Definitely be keen to dig into primary health properties, deeper dive into that. The one that I like the least, probably Wilmington.
So I'd probably agree, without sounding boring. We do both own Rightmove, so it's hardly surprising. I think in terms of the results, in fact, probably in terms of the valuations, I think PHP and Taylor Wimpey are maybe looking slightly more, well, they're looking very attractive, I think, potentially. And then, I'd put Wilmington bottom of the pile. There just wasn't much in there that inspired me to want to come back and look at it in another 6 months. So I would be surprised if we covered it again.
Yeah, no, I would agree with you on that.
Right, well, I think that's everything in that case.
Yeah, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.